Thank you guys, and welcome. Hello. So I'm Jay, the other one's Mel, and that's our pictures. We're pretty, aren't we? Anyway, so what happens recently in Congress? So to be honest, there is a lot of things happened in Congress recently, which is really particular because that building that you're seeing on the screen doesn't happen there that's like good or material. But lately stuff has happened, maybe not good, but definitely material. So let's take a look. We're going to basically focus on just the tax situation that has developed over the past couple of weeks. So the House and Senate both passed what's called the Semiconductor China Trade Bill. They have been trying to pass this bill for over a year. The Senate passed a version, the House passed a version that was different, and then they go into what's called a conference, and they try to work out the deal to basically strike the stuff that the chambers don't agree on, and just do the stuff that the chambers agree on. Oddly, that conference did not create this bill. That conference, I think, is still going. So that's kind of a unique thing. It's just kind of hanging out there. Hopefully nothing comes from it, but this bill was did not come from that conference committee, although provisions did. And also the return to Build Back Better. We'll go into that more, but it was a surprise to nearly everyone in Washington that this bill came back to life. So let's look at the Semiconductor China Trade Bill. It basically has one tax provision, which is right here, the 25% credit, and it's for manufacturers to create semiconductors here in the US. This provision is basically built to be direct pay, which means the government will write you a check for the refundable tax, the refundable return that you might get. And so you can use the cash to basically, instead of waiting for the end of the year on a tax credit, you can get a check from the federal government and use this to do whatever the company wants. This bill is now law. Here at the bottom, Biden signed this bill into law yesterday, and so it is now in the books. This bill was probably the easier to pass than the next bill that I'm going to talk about. And so the next bill needs a little bit of a ramp up. The next bill includes tax increases, and so only Democrats in Congress wanted to advance tax increases, and maybe not all of them, but basically what they had to do is they had to rely on a budget tool called reconciliation. Now, this tool was built back in 1974 in the Budget Act when inflation was sky high, and basically lawmakers were like, we're spending a lot of interest on our debt. Why don't we create a way to enact legislation that can reduce the debt, thereby making it, having it require fewer votes to pass the Senate, and therefore we can reduce the debt. Well, now that's changed to where whenever a party's in charge, they just basically use reconciliation to pass whatever their provisions are that they want. So it's basically now a tool used as for partisan politics. And so if one party has 50 in the Senate and the White House and a majority in the House, reconciliation is the legislative tool of choice lately to get a bill through. There are some drawbacks to this. It can't be permanent. It has to affect the budget. So you can't basically put in here that, college tuition can be X. You can't really do stuff like that. It has to affect revenue. It has to affect the deficit or the debt. And so it's hard to actually get provisions in the bill that fit, that also go with what the political parties wanting to advance. And so what they have done now is they have used budget reconciliation to advance the next bill, which was commonly referred to as Build Back Better. Now, the House passed this bill back in November of last year, and they thought it was going to just go through the Senate. It did not. But here are some of the tax increases that are included in the bill. And I'm not going to read them for you because you can obviously read them yourselves, but just the list, and this is not inclusive of every tax increase in the bill. This is just what I have shown here. And it really was an astonishing amount of tax increases that the House passed. And the funny thing was that not every Democrat in the House was on board with this bill, and yet nearly, I believe nearly all, but maybe two of them voted for it. Don't quote me on the two, but basically there was more who disagreed with this bill than actually voted against it. So one of the things that I want you to look at here is that these are the other provisions. These are the tax credits, the things that people get in return for doing things. The modified child tax credit. This is something that's going to haunt the Senate once I get to the Senate bill. It's something that a lot of Democrats want, and so it got onto the House bill. Many of the green energy things that you see here are in the Senate bill, but I'll talk about that later. So this is what's interesting. These are the tax provisions, tax increases that didn't get into the House bill. The reason why they didn't was because a senator said, I don't want a rate increase in the bill, which is kind of funny because, you know, the people in DC, we kind of laugh, well, what about effective rate increase? Are you okay with that? And do you know what effective rate increase is? And so this is what got pulled from the bill. And a lot of House Democrats wanted these provisions in there. They were banking on these provisions to show, like, look what we did for you. We increased the top rate on the income tax for their voters, because these things pulled extremely well for certain Democrats. And the fact that they were struck from the bill because of one senator really irked a few lawmakers, because they thought, why can't this be in the bill? They find it just. They think it's the way it should be, but it just didn't work out that way. So it got cut. Many of these bills many of these provisions actually got through committee action on the bill, and so they were pulled kind of after the fact. So the House passed it in November. Roughly 3 weeks after that, we found out that it wasn't going to pass the Senate. It just didn't have enough stuff to it. So on the 27th, roughly 3 weeks ago, the Senate Democrats released their modified version. Now, it didn't go through any committee, and there's a few reasons for that. And I won't go into the details because it'll probably bore you guys, but this bill did not go through committee. This bill was literally written from the so-called behind closed doors. And one thing that a lot of people who support this bill are saying, that it doesn't raise taxes, it closes loopholes. That's kind of funny, but anyway, the Senate went through a very long process last weekend, and they actually passed this on Sunday late afternoon. And so now it is back to the House to see what they're going to do with it. And to be honest, the Rules Committee is working on that right now. So Mel, I'll hand it over to you, big guy.
Yeah, well, let's
talk about this.
Thank you, Jay, for that. And that gives us, I think, an excellent background of how we got. Now, in addition to changing things, in addition to things, the Democrats also felt it was important to change the title. So actually, we are no longer building back better. We are reducing inflation. Okay. How are they reducing inflation? Well, they're increasing some government receipts, which presumably will help with inflation. Although Secretary Yellen continues to say that this is primarily a transitory. We have gotten, I think, a little higher than was otherwise expected. So we're no longer building back better. We are now part of the Inflation Reduction Act. And the Inflation Reduction part are tax increases. Let's talk just very briefly about what those tax increases are. Jake, if you can move us on to the next slide. I think we have some details here. And the big piece, and I think one that probably has gotten the most publicity in the newspaper, is the 15% minimum tax on the book income of corporations. Now, this only applies in a situation where the corporation and the businesses within its controlled group, for those of you who are into definitions, you have to be more than 50% owned in order to be controlled. So it's not just the consolidated, it's not just the potentially consolidated, it's the full majority owned businesses, but it is on corporations. And you got to add everything up together and get to an average annual adjusted financial statement income of $1 billion. But it's not just the average annual adjusted financial statement income. In fact, Jay's going to talk a little bit about how this sequenced in a minute, but at the last minute, a change was made. So instead of book depreciation being included in this calculation, you get to keep your tax depreciation. So, and I think that although there's still some studies to be done, there's some work to be done, every large corporation is going to need to look at this. If you are primarily involved in domestic manufacturing, there's a good chance that if you were on the borderline before, you're probably not going to be on the borderline on a going forward basis. So it's there. If you're big enough to be covered by it, it's certainly something you need to be cognizant of. If you're not in that area, so at this point, I would not immediately jump to this one. The second big piece is a 1% excise tax on net stock buybacks. Now, this applies again, well, not again. This applies only to listed corporations. You have to be listed on some sort of formal exchange. Yes, the NASDAQ is one of those exchanges. The so-called pink slip stocks are not. And again, this only deals, there are a series of exceptions to this. So even if you are a publicly traded corporation, it's not a 1% excise tax on any stock buyback. It's a 1% excise tax on the net amount of stock buybacks for the year. And so we get to offset any stock buybacks with new stocks that are issued. That includes new stocks that are issued for the purposes of cashing in options that employees or others may hold. There are also a series related to other kind of funding of retirement plans that may be existing out there that are allowed. And finally, if a company buys back stock in order to fund an ESOP, an employee stock ownership program, those buybacks will not count. And so we have one more reason why employee stock ownership programs are frequently a nifty way of addressing the interest of your workers, and also at the same time providing some good tax benefits. Jay has, I'll say as an aside, Jay has made some arrangements through the National Association of Manufacturers for I-Bailey to be working with them on some presentations with regard to ESOPs. For those of you who are members at NAM or thinking about membership at NAM, we're looking forward to going into those sometime this fall. But again, it is an interesting opportunity. There is a limitation on the excess business losses of non-corporate. They have extended that 2 years. Yes, this is going to affect a number of people. That has been extended for 2 years. It's going to apply to tax years now that end before 2029 instead of before 2027, which was the old rule. Yes, and in fact, this is the reason that there is some discussion that there potentially are tax increases here for the under $400,000 taxable income group. But again, ones that are not necessarily going to be out there. The Black Lung Disability Trust Fund has been extended, and for those of you in the petroleum industry, the exception that you had to the restoration of Superfund goes away. I believe that the new rate is 36 cents a barrel. That will be indexed for inflation, or will be indexed for future inflation. And it has been a good while since Superfund taxes have been assessed and collected really on anyone. And while there is some anticipation that the rules of who needs to pay, who needs to report are going to follow the rules that we saw back in the 1990s when people were still having to pay these taxes, we don't yet know that for sure. That's the inflation reduction piece. More money for the feds, presumably less federal borrowing, a little less inflation. That's what at least we're going to operate on the basis that is. And that then raises the question of, well, okay, here we got what else is there that may have been raised? And although it is not a direct tax increase, there are some increases in funding for the Internal Revenue Service, specifically directed at the ability of the Internal Revenue Service to collect revenue as well as actually process the paper that seems to be, I think there's a story today passing around about the paper that is piled up at the cafeteria at several of the processing centers. Yeah. But Jay, you've been following this one a little more closely. Why don't you walk us through this part of the anti-inflation activities?
Yeah. So can I switch to the slide?
Yeah, please.
All righty. If I can do it for some reason. So let me back up some.
Oh,
so,
yeah. Do we?
Yeah.
I'm sorry.
I'll go into the other thing later. So over the weekend, the Senate worked throughout Saturday night into late Sunday afternoon to pass their bill. When they started, they basically said that the expectation was no amendments were going to be accepted and some Democrats have said, I'm going to vote no to every amendment to make sure no amendment got accepted, because Senator Bernie Sanders actually wanted to have amendments added to the bill, and the other Democrats were saying, no, it's just going to mess everything up. Don't do it. And so we're just going to vote no. Along about 2 o'clock in the afternoon on Sunday, a reporter reached out to me saying that Senator Sinema from Arizona no longer supports the bill. So originally she said, I will support the bill if the parliamentarian agrees that the bill conforms to the reconciliation rules. So go back to that previous slide, talked about reconciliation. Basically, reconciliation, the Senate parliamentarian is the one that says this is either in or out of the bill based upon if it conforms or complies with the rules. But this isn't a self-executing thing. A lawmaker has to go to the parliamentarian and say, hey, here's a problem with this. What do you think? And so then it becomes the parliamentarian's issue. Well, what happened with cinema was that the parliamentarian agreed with the bill, but there was provision that she didn't like, and it was the minimum tax basically being allowed to affect private equity firms. And so she was a no on the bill, I was told, around 2 o'clock Sunday afternoon. A lot of people started to wonder, is it gone? Is this bill not going to happen? And so and I don't understand why, but a Republican offered an amendment that X'd out private equity being a part of the minimum tax computation, and it was paid for by extending the SALT cap for a year. So that's something Democrats wouldn't want to do, but Republicans would. And so it wasn't clear how this was going to happen, because if a bill gets, or if an amendment gets 50 votes, it's not added to the bill. It needs 51. It's a simple majority rule. And if every Democrat is against the SALT cap, how is this going to get on? Well, what they did is they basically said, okay, let's agree to this amendment and then amend it. And so what they did is that they basically allowed the private equity to no longer be a part of the minimum tax world, but instead of paying for that difference, instead of SALT, they're going to do the extend the limit on excess business losses. Now, this is probably 2:30, 3 o'clock on a Sunday afternoon, and it is the first time that we have seen the people in DC that deal with this stuff that aren't on Capitol Hill. It's the first time many had seen the amendment that says, hey, we're increasing the limitation on excess business losses. Well, that's a huge issue for a lot of companies, and it was just thrown at them. There was no time for them to even react. They couldn't get into the Senate and say, hey, stop this right now. What are you doing? And so now what's going on is there's an effort to try to change that in the House. The idea that that's going to change in the House and force the Senate to come back to agree to those changes is nil. And so this provision, this extension of the excess business losses will become law. How long? I don't know. But it's definitely going to become law. And people are trying to figure out how to work around this now. And so that was some of the drama that happened over the weekend, that there was a moment when many Republicans I spoke to were elated that this bill was not going to happen. And the Democrats I speak with were just dumbstruck. Like, how did this happen? And so, but it got worked out. And then the bill passed, I want to say around 3:30 on Sunday afternoon. And now it just awaits itself for action in the House. The Senate is done with this bill. There is no more need for Senate action on this bill. Also, the mere fact that this bill passed the Senate, the Build Back Better bill that passed the House in November is gone. It's not going to do anything. So here are some of the other provisions, and they either raise or save revenue for the bill. Saving revenue is Medicare can negotiate the price of prescription drugs. Raising revenue is the increased funds for IRS enforcement. Now, the leaders in Congress on the Democratic side are basically saying no one making under $400,000 a year is going to be affected by this enforcement increase for the IRS. That is not in the bill. The enforcement section in the bill of the IRS does not say no one making less than $400,000 can be hit by this bill. All right. But IRS Commissioner Redding has said that no one making less than 400 will be affected by this bill. So what they're saying is that the audit rates that we currently have for people making less than $400,000 will stay about the same. So I wouldn't tell clients, hey, you make less than 400 and the IRS just called you about your EITC. Well, just tell them, don't worry about it, because I make less than 400. So, you know, nuts to you, you can't audit me, haha, because they still can't audit you. So here's some of the breakdown on what the IRS is going to get. And if I don't know if I can highlight this, I can't highlight it, but this first number, so it's going to get $80 billion. Over half of that is going toward enforcement. So, you know, the paper problem, yeah, they got a real big paper problem. It's huge. There was an article, I believe, in the New York Times a couple of days ago that had the pictures of the cafeterias where these, instead of eating there, it's just a bunch of paper. Google it. It is amazing how much paper are in these offices. But most of the money is going for enforcement. Now, I don't know if that means they're going to deal with paper. You would think it would be under operations. So I don't know. But this has really concerned a lot of people, mostly Republicans, saying you're saying you're not going to increase enforcement, but it gets the most money. And so there is questions on how are they really going to enforce this when it's not really in the law. Mel, you want to say something?
Nope. Sorry about that.
No problem.
Well,
So,
no, I will say something.
Yes, you will.
Yes, I am, because now we've talked about the tax increases that are going to hopefully reduce inflation. But, you know, this is not all tax increases. This is not all changes. This is not all additional IRS examination. Now, it is not quite the pot of gold that we've gotten over the past couple of years with regard to COVID relief. But then again, I'm not sure that any of us really believe that that is the kind of pot of gold that is called for. There is $370 billion of enhanced environmental alternative energy incentives. No, there's not something here for everybody, but there are a lot of opportunities that are present here, certainly for those that are already involved in this direction, maybe even have not thought about whether or not you are involved in this direction. There are opportunities here that are intended to be taken advantage of. The goal is to reduce our carbon footprint by your taking advantage of them. And I certainly, for one, think that it is would be a good thing of what. So let's talk a little bit about what we have here. Now, the big pieces traditionally on the environmental side have been Section 45, which is a production credit, and Section 48, which is essentially an investment tax credit for building out energy sources, solar, wind, biomass, geothermal, tidal, if you have figured out how to capture that one. And those were coming to, those were about to expire. The legislation here extends those primarily, or generally out through a period when so long as construction begins before 2025. Solar was falling off of, and in fact had fallen off of the list. Solar is back on the list. It is back on the list retroactively. We can use this for projects that are placed, that are construction begins in 2022, items that are put in service in 2022. Some of the wind and certain other kind of facilities were on a limited basis. You didn't get the full amount of the credit. The legislation here restores them to the full amount of the credit. Used to be that if you used tax exempt financing, and this is not uncommon to be able to go to an area, particularly when you talk about the conversion of biofuels into energy, i.e. setting fire to the trash heap. Previously, you lost half of your credits. You could only count half of your basis as eligible for the credit. That drops down to 15% under this new. And we'll throw in a couple of 10% bonuses. If you put your facility in a quote energy facility, brownfield site, area, let's hit CPE. Come on, everybody. Everybody hit your CPE button. A brownfield site, an area with significant fossil fuel employment, or census tracts where a coal mine has been closed or a coal fire unit has been retired. Where did all this come from? Well, let's not forget who needed to get comfortable with the environmental provisions here, and certainly a deep desire to make it clear that this was that we were taking into account the fact that there were going to be areas of the country that had been primarily coal dependent, that as we moved away from the use of carbon would be adversely affected. And this is not just a particular state immediately to the west of the Commonwealth of Virginia, but also we know that this will be applicable in a number of states where coal production, coal-fired use has been common, particularly in the West. And for those of you who are in these communities, this is something to clearly take a look at. We want to encourage people to build stuff in the United States using United States stuff. So we'll throw in a 10% bonus for meeting certain domestic content standards. Now, these are, we're going to see several domestic content standard rules filtered through these new changes. They are not all consistent with each other, and I'm not at this point going to try and separate them out in the time that we have, but it's as we go forward, this is something that I can assure you we will be looking at. There is a but, and again, there's this fair amount of social issues being taken into account here. In order to claim the full credit for Section 48 is a good example. You get a 30% credit under Section 48 if you meet new wage and apprenticeship tests. If you don't meet those tests, you only get a 6% credit. Now, what prevailing wage is going to mean, what prevailing wage is, may or may not be sufficient to off, or the additional credit may or may not be enough to offset that, but it is certainly something that is going, if you're going to get the full benefit of the credit, you need to meet these. Okay, what are these wage and apprenticeship requirements? Well, first of all, it says you need to meet them 60 days after the IRS publishes guidance. A little problem here, some of these rules seem to be applicable now. So how we're going to match that with the 60-day rule, we may need some guidance as to how we're going to handle the 60 days of guidance. But from what we can see, from what is in the statutory language, from what is in some of the descriptive materials that were provided to the members before they voted on this, essentially what we're talking about with a wage requirement is the prevailing wage for the locality in which the project is located for the activity that is being performed. Essentially, or excuse me, what we expect this to read is whatever was going to constitute prevailing wage for the purposes of working on a federal government contract is how this is going to be applied. I know that there are circumstances where a prevailing wage in a particular area may be considered higher because of a state tax requirement. We do not yet know whether that's going to be applicable or not. At this point, it's the federal performance on a federal government contract that appears to be the area that people are going in. The apprenticeship requirement, a little unclear how this is actually going to work in practice. What it says in the statute is qualified apprentices must perform a minimum percentage of total labor based on the total labor hours on the project. And in 2022, that's 10%, 2023, 12.5%. After that, 15%. And you got to pay them the prevailing wage. But where do you go get the apprentices? Can you get an apprentice? Well, if you request apprentices, doesn't say who you have to request them from. Kind of a suspicion that the easier place to get this is going to be from the union, but not by any stretch of the imagination required. There are apprenticeship programs outside of the formal labor unions. And your request was either denied or nobody wrote you back within 5 business days. You are excused from the apprenticeship qualification. So we're going to have to see, it's going to take a while to see how all these play out in practice. These are rules that are there. These are going to apply not just to the 45 and 48 credits. This is going to apply to a wide range of the environmental credits and benefits that we're going to be looking for. And so it's something to keep in mind that this is, if you're going to play the game, if you're going to take the advantage, then be aware that this may well be rules that we're going to have to comply with. Looking at some of the other specifics, Section 179D, the energy efficient commercial buildings. Now, this is, this is the idea. You put up the building and you have reduced associated energy costs compared to a standard, and they're updated the standard in this legislation, and you get a credit. Or actually, excuse me, you don't get a credit, but you get a deduction. The deduction generally was up to about $1.80 per square foot. Worked great in the context of warehousing. In some standard commercial buildings, well, they took 179D and they made it a good bit better. Now, they did update the standards, and that's something that is, going to have to be factored in with the engineering. But if you beat those new standards by 25%, then, and by the way, you also meet, you'll see down here at the bottom, you meet your wage and apprenticeship standards, we'll get you up to we'll start at 250th. And to the extent that you can do better than the 25%, we'll give you an extra dime deduction for every additional percentage point. So if you're talking about a 30%, if a 30% comparison, 30% reduction compared to the standard, then we'll talk about $3 per square foot deduction with respect to putting up the building. Now, keep in mind, the costs that are associated here are primarily costs that are otherwise going to be treated as real property costs. So the ability to deduct versus the necessity of depreciating over 39 or 40 years is a significant benefit. You can come back. It used to be under the old rules. I guess we really say the current rules, because it won't be the old rules until the House approves and the president signs. You essentially got one shot per building. Now, once you've been in place for 3 years, you get another shot at the building if you engage in some sort of retrofitting. What had been a lifetime cap has now been changed to a 3-year cap. And because we're extending things, these changes are now going to be applicable from 2022 out through 2031. Some situations you may have looked at 179D, you may have decided it's interesting, but it's not necessarily, there's not necessarily enough here to quite make it worth the effort. There's more here now, and it may well be worth the effort to take a good hard look at that. Some other changes that we're seeing, there are a lot of changes with respect to electric vehicles, called also alternative fuel vehicles. More availability, more cars are potentially going to qualify. The dollar limitations, the unit limitations that we saw under existing law are no longer going to apply. So yes, Tesla had sold too many units, Toyota had sold too many units. They can be brought back into the game. The credit will be bigger. But the problem is, once again, we've got US domestic part requirements. We've got wage and apprenticeship. Now, the wage and apprenticeship, I'm not sure is going to be a big problem, but we are already hearing from the automakers that they do not see how they're going to meet the new requirements with respect to US content, particularly with respect to the idea that we need to have US production, US content of the batteries. And that is an area that is going to require, I think we will be seeing some further work going forward. As has been pointed out, and I'm sure you're seeing these things in the paper, there are an awful lot of cars right now that you would think would qualify are not going to qualify. Cars that are on the lots right now, cars that may be coming to the lots in the next couple of years based on the planning that the automakers have. It's going to take a while for this to adjust, but somewhere farther down the road, there is some potential here. Advanced energy project credits. Those of you who have been in practice for a number of years may remember Section 48C. 48C, it used to be the focus for alternative energy was essentially the production of electricity. You could get a credit for producing the electricity under Section 45. You could get a credit for building the plant that produced it as an investment credit under Section 48. Someone spoke up and said, well, wait a minute. You're not going to have a windmill unless I make windmill blades. You're not going to have solar power if I don't make some solar panels. How about giving me a credit too? And lo and behold, that is what Section 48C did. It provided a credit subject to a dollar cap that went to the building of plants to produce the parts that were needed. Now, as I said, it was subject to a dollar cap. I believe it was about $2.5 billion, which, by the way, they was well oversubscribed. And those who got in first did the best. Most people only got a fraction of what they otherwise would have been entitled to because it was oversubscribed. 48C has been brought back. It's been expanded to include some things as technology has developed in the decade that it has been away. And they have quadrupled the amount of dollars up to $10 billion that will be available under 48C. And throw in on top of that, 48X, another new environmental incentive, is not only going to provide a credit for the items themselves that are produced in that plant. So 48C addresses the production line, addresses the production machinery. 48X is coming in to cover situations that will where we're actually producing the blade for the windmill, where we're actually producing the solar panel. Details as to how those two are going to be fit together, pending. Not clear that we're going to be able to get what some people might look at as a double count, but it is something that is coming through. With respect to 48C, to 48X, with regard to some of the other incentives, we've got a whole new set of rules regarding refundability and potentially regarding the sale of the credit to others. And refundability is, I mean, it's exactly that. It's what Jay was referring to with regard to the semiconductors. It is, you treat it, the payment, the credit is treated as a payment of tax. So consequently, at least on a quarterly basis, and actually depending on procedures that you use, prior to that quarterly event, you can translate it into cash from the government. Now, you have to ask the government for the cash, which means they're going to have to process this. You can't just take a piece of paper down to the bank and say, I'm going to get a credit. They might loan you against it. They're going to charge you interest. But it does create a situation where startup business that otherwise wouldn't be able to use its credit, a business that for whatever reason has hit a bad year tax-wise, has just overused the benefits, has knocked the tax down so that it is looking for the use of this as a refundable item rather than simply as a credit against tax liability. In those situations where you're not able to translate it into a refundable credit, a number of these provisions are going to simply, a number of these incentives are simply going to be saleable. Now, it has to be sold to cash for cash. It has to be sold to a independent third party, but there will be a way to cash out without necessarily jumping through the hoops of bringing in an investment partner and structuring the partnership so that it goes. Again, not something that we hadn't been able to accomplish by and large in the past, but certainly, and I think very much to their credit, simplifies the ability to get there. One specific other one that I do want to mention is, and this is, although it was existent in the existing statute, is very much expanded here in this new legislation, is the carbon capture. Carbon capture has been somewhat controversial among environmentalists. Many would say, well, rewarding you for capturing and sequestering or capturing and otherwise doing something with your carbon emissions, that just encourages people to keep using carbon emitting energy. Well, yeah, I think it's, well, a lot of what we have seen recently is we're not going to do away immediately with coal. We're not going to do away immediately with oil. We're not going to do away immediately with natural gas, or for that matter, with other commercial activities that, short of burning a carbon substance, release carbon into the atmosphere. So this unquestionably is going to have a place in any sort of environmental movement that we see legislatively going forward over the next years. The credit, which was supposed to expire at the end of last year, has now been extended, or excuse me, was going to expire at the end of 2026, has now been extended through 2032. The amount of tonnage that you have to capture has been reduced. This is going to make it viable for some smaller emitters to become involved in this. The credit rate you get has been increased. Now, once again, we need to meet wage and apprenticeship rules, but the credit's 5 times as good if we meet those rules than if we don't. Carryback rule is expanded. We can monetize it. We can transfer it to third parties for cash. And we get a 5-year depreciable life for what otherwise might have been significantly longer lived properties with respect to this. We're going to see a significant increase in the number of years of approaches that are trying to take this. Traditionally, this is something we've seen in oil production, because you capture the credit, you capture excess carbon dioxide as it comes out with your natural gas, and then immediately put it back in the ground to try and generate more natural gas, push more natural gas up your well. We've seen it in some of the larger electric power plants where you've got a very, very significant stream. But we're also beginning to see this now in situations where smaller producers, not necessarily because they are going to claim the credits themselves, but putting them together in networks may create a situation where this is going to be become economically practical under these new rules, where it was not economically practical before. iBailey does have a webcast that will specifically focus on carbon capture, will specifically focus on these changes, on the commercial potential of this for later this month. For those of you who are potentially going to be in this market or simply curious about how this is going to work, very much hope that that you will join us for that. That covers, I think, some of the highlights. There are many other provisions on the energy side. We will be coming back. We will be producing some additional materials with regard to those. Be on the lookout for that. And with that, I'm going to turn things back over to Jay to wrap up our Inflation Reduction Act, as well as talk a few minutes about what we still may have on the table for the rest of the year. Jay?
So this is a self-explanatory thing. The House of Representatives was scheduled to come back yesterday. The vote is supposed to happen on Friday. Today, the Rules Committee is looking at the bill. They're the ones that basically create the rule for how it'll be debated on the House floor. They can adjust that rule to whatever. Passage is likely, if not highly, extremely highly. And so if it doesn't pass, it's going to be a mind blow to everybody in Washington. So there's a lot of taxes that haven't been dealt with yet that should be. And so I'm going to look down the road, and this is just what the expectations are currently. You never know if that's going to happen or not. But here it is. So the R&D, instead of it being amortized, they want to go back to let it be expensing. They want to basically expand the interest deduction, possibly a LIFO fix, especially for car dealers, and then the employee retention hiring tax credit. These are things that are left on the cutting room floor when it comes to the Inflation Act. There was hopes that they would be in there, but they didn't make it in. And the big reason they didn't make it in is because if you look, these are all pretty much business tax provisions. And there's a group of people, lawmakers in the House, that wanted to extend the child tax credit and other family-oriented tax credits instead of these things, or let's do them together. And there's no way that this bill would pass the Senate, because the reconciliation bill that is the Inflation Reduction Act has protections that allow it to pass with just 51 votes, which is what it got. Other bills would require 60 in the Senate, and that means 10 Republicans would have to support it. And right now, there's not much appetite in the Senate among Republicans to extend any sort of child tax credit or other family-oriented tax provisions. Their argument has been since last year that the child tax credit enacted under the Tax Cuts and Jobs Act is good, and we should just stick with that. So that's where things lie right now. So the Retirement Secure Act also is something that is waiting action. This was approved by the House in March, and then the Finance Committee actually passed its bill. It's a little different than what the House passed. And right now, they are supposedly working to get a bicameral bill on this that can pass both chambers. But currently, there's not been much talk on this bill, but it's got bipartisan support in both chambers. And so the expectation is that we're going to see passage of this bill at some point between now and the end of the year. But don't hold me to that, because you never know. So there's also a long shot. So when I was talking about the Chips and Science bill, the Semiconductor China trade bill that passed, like I told you before, there was a conference there that was a part of that, trying to build a bill. That bill is still kind of out there hanging, and there's been some talk of adding tax provisions to that bill and then have that bill pass. If that were to happen, which is a long shot, but if that were to happen, it would only be the tax cuts or credits, would not be tax increases, because this bill would need Republican support in the Senate to pass. But still, this is a long shot. It's just something that people are talking about because there is a piece of legislation out there waiting for action. So the most logical move right now is a bill after the election. It's called the year-end bill. It would also need Republican support. So it basically would only be the tax extenders and other tax credits that would be extended. No tax increases would be in the bill. So there's talk about it maybe being a standalone bill or maybe being added to another bill, maybe a retirement bill. So no one knows, but the most logical next move after the Inflation Reduction Act passes is that Congress will focus on the upcoming election, get the election over, and then move a year-end tax bill where the partisan differences of I won't support the child tax credit or I won't support business-oriented tax breaks fall away, and they can basically move a huge bill that would be tax giveaways or credits or breaks to everybody. And so that's the idea that might happen. You just never know, because maybe people are still going to be mad about the election. So just wait to find out. So if there is no tax legislation in 2022 at the end of the year, basically what's going to happen is Republicans are expected to take over the House. They're going to move a bill at the start of the year that would include an R&D fix, a 163J fix, possibly LIFO fix. So that would happen toward the end of the at the beginning of next year, assuming that House Republicans take the House and Senate becomes Republican controlled as well. Oh, this is another thing. If Congress switches party, look for investigations into how ProPublica got so much tax information. There's a lot of gotcha sort of hearings that are supposed to happen that will only make the partisan split worse next Congress.